And so we've received these since a few days ago, once we put the deposit, and you can see that they've been running pretty smoothly for the past few days. What does that earn us? That earns us, in this case, 0.4 Bitcoin. And if this is for an allotment of 1,000 machines, and of course we'll have close to 5,000 machines, so essentially think of this as 5x. And that's essentially every one of these Bitcoin that we receive every day, we receive it in our wallets. And then after we pay the expenses for the electricity costs and whatnot, we then send that to investors.
Yep. Beautiful. So it shows you in real time how the miners are working. They're working 24 hours. So this is last 24 hours. Beautiful.
Yeah, they're working 24 hours. And you can see that we essentially got them online because we paid a deposit in September, end of August, to seal the contract. And as part of that arrangement, I wanted to have the miners essentially pointed to us, so to highlight the online now aspect of it. And there will be some variability, and the variability stems from two folds. One is energy prices sometimes get very high, and as part of the contract, we will be online 98% of the time. So on the 2% of the time, we'll be offline because the data center provider will have more economic reasons to essentially sell the energy to the grid than to have us mine Bitcoin. And that's an exchange we get for essentially having a reduced cost. And in addition, it's going to happen more in the summer when this is hotter and these machines run hot. So once it gets into winter, this is our North Dakota side. I have it coded in North Dakota. So right now it's hot everywhere, as you can imagine. I was just in Ohio this past week, and I'm going to with my good friend Vinney to Houston next week, and it'll be very hot.
Excited about it.
Is it one of our joint projects in real estate? And I like the real estate aspect of this because every day we get my Bitcoin. Every month we have to pay our power and OPEX expenses. Given today's price, we're going to be around 50% profit margin. So really good profit margin. And the net of that profit will then actually be given to the investors. And
90% almost.
Yeah, 90%, yeah, exactly.
Oh my gosh. Yeah. And then also the 10/30, cost segregation. Could you kind of talk about that too? I mean, we are able to, because machines are disposable, or what's the word? We could cost segregate it over 5 years, but bonus depreciation. Please go ahead.
Yeah. So I'm excited for this one, especially because if this is the last year you can do this, so any equipment that generates income, any asset, essentially, you can depreciate it. And depreciation just means that you're going to take the lost value of what you bought it for. And so we're going to do it all in 1 year instead. So of all the money that goes towards these machines, which is almost all the money, close to 95% of the money, we'll essentially be giving a write-off in the first year, which then we'll split pro rata to investors, depending on, as well as for the LPGP share. But yes, for the investors.
Hi, you are listening to Syndication Made Easy podcast. We will be right back after this short break.
Hi, thank you so much. This is Vinney Chopra, and thank you for subscribing to my podcast and YouTube channel and Facebook pages and all the great things, and LinkedIn. Connect with me. I come live to you every Friday at 9:30 Pacific with Vinney and Bo show. Please also look at that. And also the podcast, which is my apartment syndication made easy. The book I wrote a couple of years back became international top seller on Amazon International now. And then we like to bring great guests for you every week or twice a week sometime to give you a lot of great knowledge. So please subscribe. You give us 5-star reviews on the iTunes. The better the guests we can bring, and our ranking will go higher also. Thanks again for following us, and really getting the most out of it, please comment, like, share, because we would love to bring better and better material for you.
The investors, they'll get a significant amount of K1 loss. So even if you're seeing a return of X%, if you take account the fact that you can get this benefit and essentially use that against other investments, that's where some really savvy investors do it. I know that's.
I love what you just said. Because we'll be probably giving 3 to 6% per month, right? Let's assume that, depending on the numbers. So that's almost 12 times 3 is 36% back of the investment. It will take about 2.5 years to get everything back, but then I can reinvest that money into other vehicles, but this will keep on paying me for 5 years or something, right?
Yeah.
So it's a 5-year hold, we say, your investment is, but we return through cash flow in Bitcoin or the cash, you could get it back. Yeah, please, if you could explain this. Yeah, thank you.
Yeah, so I know some of you guys have, already talked to Vinney about it, and I just want to highlight that Bitcoin mining will always fluctuate in returns. It's not a predictable fixed thing, because the outcome of Bitcoin mining, as I shared with you guys earlier, is Bitcoin, and that amount of Bitcoin does fluctuate depending on a few factors. One, what does the competitive landscape look like? What's the difficulty? So difficulty does adjust. And so in the normal course of business, when you see a very profitable industry like Bitcoin mining, as it was last year, you will see a lot of investments, a lot of capital investments come into the space, essentially double the size of the industrial mining capacity. Yet the output of Bitcoin mining remains limited, meaning the same. So if over the past year, essentially what happened was, my competitors grew by 2x. My profits decreased by half. Now my profits were 80% before, so they're very high. Now they're less. But I just want to highlight that will be a factor in this investment, and it's hard to predict. Surely over the course of 5 years, what Bitcoin price will be, what difficulty will be. So in this top section, I just wanted to make it like, if our model was flat for 20K Bitcoin and difficulty was flat, another constant that is also, what I talked about in this model, we would essentially yield close to 4%, 3.9% a month in return. So not the best investment from a return to capital perspective, but if you held Bitcoin and Bitcoin was stayed flat, you wouldn't make money. You actually make zero, right? You just bought Bitcoin, it would stay flat. You wouldn't make money, but you get a tax benefit in addition. So that's why the IRR is so much better. If you're assuming you can use that at a federal tax rate level, then you get a much bigger benefit. A lot of people invest in deals for the tax benefit alone, and they assume that maybe they can get 3% a year in returns. This is 3.9% a month in returns. And then some people invest for the great cash flow. And so they get cash flow at maybe 1% a month and 3% a quarter, but they don't expect any upside on the back end. Well, in this investment, because we're giving Bitcoin as an outcome, and of course we can sell it and give it you in cash, you have both the cash flow, the strong cash flow, but you have the upside benefit. So it triangulates three things that usually doesn't go well together: tax benefits, cash flow, as well as upside opportunity. And in these models, I'm assuming that you sell Bitcoin every month. So I'm not assuming that you actually hold Bitcoin, and if it goes up, you make a lot more money, which I hope you do. But in the model, it's not saying that. The model is saying that what will happen over the next 5 years, depending on these factors. And because Bitcoin mining is our cost to mine Bitcoin is around $10,000 to mine one Bitcoin, meaning that we have to pay $10,000 worth of expenses to mine one Bitcoin. And if Bitcoin was at $15,000, we have $5,000 of profit.